morning, traders. Welcome to the TMT Stock Market Strategy video for Monday, November 28th. All right, so we had market highs on Friday with that short trading day we did after the Thanksgiving holiday. All posted new all-time highs on extremely low volume. So I'm really discounting anything that happens going into that holiday week. Markets continue to ramp up. And we are getting to a very dangerous part of the equity markets. And what I mean by that is that I did a little bit of research over the weekend going into the post-election. Okay, and I looked at some similarities with the Trump election, the Reagan and Eisenhower. Those are the two that really stand out. And the equity markets had a very difficult time after the election. Reagan markets were down about 22%, followed into December, all the way down into March or April of that year in the 80s, and actually had a difficult time all the way from 80 to 82, and then the Eisenhower era. So you have to be careful. We're at extreme complacency levels here. We have the put-call ratio reading at 80, which is bullish. However, as a contrarian, that's extreme complacency. VIX below 12. Again, just saying to use caution. They're not saying to liquidate everything. What I'd like everybody to do would be to hedge, since the volatility is at extreme lows. It's very cheap to hedge your portfolio. We're at 2,200, no volume, and it's just something that to me, I've seen this song before. It just ends very bad, and doesn't mean it's going to happen today, tomorrow, or even next week, or even into the new year. Interest rates are rising. It's another thing to be worried about. If interest rates are rising, and similarities from last year, we had in December after the tax selling, we started to sell off again, and then you know what happened in January of 2016. We melted down for about 8-9 trading days. So just something to be very careful about here. Okay, when I see things like this, and I can go on and on, but with the video so short, I'm not going to be able to do so. But stocks above the 50-day moving average, getting to these washout levels, meaning to be very careful. McClellan Oscillator, the NAMO for the Nasdaq, they're all at extreme levels now. So we definitely do not want a shock event, because that could actually alter the markets here to actually move a little bit lower. And again, do I mean a market crash? Nothing. No one knows if a market does crash or not, and I would suspect it would not. But a pullback is actually normal and healthy for the markets, guys. It's just crazy how this market is absolutely broken when the market just go up and then does not go down. It's just amazing. We do not have the free-flowing markets that we used to have, Anyway, all right, let's get right to it. You see the dollar UUP ETF. And like I mentioned down here, I said that back in July and August, don't count the dollar out. And sure enough, we're at a point right now where this move is definitely for real, and we'll put a bottom line on these multinationals here in the U.S. So the dollar also is a canary in the coal mine where it needs to be watched closely. Okay. Next is going to be the put-call ratio. I mentioned that to you about the put-call. Be careful. You're at 80. These are extreme complacency levels here. When anywhere it gets into this 80 area, that means that the investors and traders are very bullish and all one-sided. So, again, use caution. Okay, VIX below 12. I mean, this is getting to a point now. It's getting ridiculous that there's no volatility at all whatsoever. Now, remember, we come into the 2 weeks, 2 to 2.5 weeks of weakness, because we have the tax selling, notorious tax selling, that starts to set in, and especially if you have the markets at these highs. You're going to take a lot of investors are going to be paying some taxes on capital gains. They're going to be selling stocks that are not doing well, performing well. So you get that notorious tax selling that comes in, and that could spark a little bit of a sell-off as well. Here's the NIMO at the 59. The NAMO, which is the Nasdaq, is even at extreme levels, even at above 70. So again, something to keep an eye on. Okay. Let's take a look at gold. Well, if the markets are moving higher, interest rates also moving higher. Gold does not like that, since it is interest sensitive. However, with inflation picking up, and if you get a little bit of fear in the markets, gold's going to be a pretty decent investment for 2017. So I'm looking at it needs to hold here. If it does break down, I think we're going to be looking at the 1080 11 handle, 1100. in this area here. So let's keep an eye on that, guys. It's something to be watching going into to prepare yourself for 2017. Here's the GLD. And again, we lost that area here. And here's that thin zone I was telling you about. Got to be very careful with this thin zone here. This is something that if we lose this area, then you're looking at Friday's low, guys, you can easily get back down to 105. And I was mentioning that 105, 106 area. And I think the next flush, if we do get one, is something of interest that I would like to start nibbling into some gold. Here's a GDX holding up a little bit better. Didn't quite get to the 61.8% retracement, but that's what I'm looking for, anywhere between 17 and 19 to start nibbling in GDX. Let's go into the indexes. Spiders, you can see here, guys, literally straight up right after the election. Grossly overbought. Look at the volume. Volume has deteriorated. Right after the first day, we just dropped in volume all the way up. And I've seen it before, guys. What happens is you get a nasty 1 day down, takes out all of the 2 weeks of gains, just like we did here. We took off 2 months of gains. Right back here in September, we gapped down. We went down all the way down to 213, and sure enough, we wiped out July and August gains. Okay, so that's going to, I wouldn't be surprised if that happened. 60-minute, you could see a big bearish rising wedge here. Absolutely on low volume here, just creeping up, continually move higher. So it's a concern to me. If you're day trading, fine. Stick to the trend. The trend is your friend. But if you're looking to start adding more positions at these areas, it's crazy. Even if the equity markets went to 2,300, I would suspect the markets are always made to fool the masses. Would wipe out those gains, and then you're back to square one again. So if you have a good portfolio, I would rather hedge than look to start adding into these longs at these areas, especially when you're away from the 8. Look at how far away you are here just alone in the transports. Again, quite bullish, but remember, this market is moving higher on anticipation of what Donald Trump is going to do, okay? We have not heard much of him or his cabinet members, and he's still picking out some of his members. So again, just use a little caution here. Russell 2000, absolutely ridiculous. I've never seen a 14.5% move in 2 weeks. That's almost 2 years worth of gains if the market were to go up every day. And here you can see here extremely low volume. So, guys, to me, this is a no, this is a rubber band trade. Here's your revision to the mean trade. I mean, if anything, 126 from 134. You got a gap fill area here that's going to need to be filled. And then you're going to have a couple of gaps down here. And remember, gaps usually always get filled, so just keep that in mind. Last is going to be your Qs. And you can see here Qs haven't really performed as well as the other indexes. So just a word of caution here. Remember, we are going to be coming into a seasonal time of weakness. Okay, and use caution because we have a lot of things going on this week. We have the OPEC meeting, and we have a lot of economic data coming out. So that could rattle the markets as well. Have a great day, guys. We'll see you tomorrow.